But just for the average investor out there, honestly, even professional people like Sonu and I, professionals do this every day. This is really important to remember because I think it's not always something that we think about. When you look at the stock market, it gains about 9% a year on average. Okay, that's pretty good, right? I mean, over a long enough time frame, 9%. Here's the thing you need to know. Average is not so average. And what I'm sharing on the screen here, only 4 times, going back to 1950, has the S&P 500 gained between 8 and 10%. So that's about an average year. Think about that. Now, here's one more way to look at this. 20 times we've seen a 20% gain in the S&P 500 since 1950. That's a lot. 21 times stocks were down. The crazy thing is it's almost as likely stocks are down on a year as it is to be up 20% on the year. So these big swings, these big volatilities are normal. Over a long enough cycle, you'll probably gain about 9%, sure. But getting there might be quite a roller coaster ride. I think that's really important for investors to remember that average isn't so average and big swings are quite likely. Anything you want to add on that, Sonu, before we kind of dive into the macro backdrop of things?
I have to say this is one of my favorite charts that you put out. It just shows like, the average almost more often than not doesn't happen. Right?
Yeah.
That's what it shows. And then you start putting some conditionalities on it, right? Yes, you expect 9% on average, but of course that doesn't happen. So what else? What are the information do you know? We're looking. That's why we're going to talk about the macro backdrop, right? What's happening in the economy? If the economy is strong, profits are likely to be strong, and that means, maybe odds are in your favor that you'll do better than average, right? Which happens more often than not, I should say, right? And whereas on the other side, if you were positioned for a recession, profits are likely to go down, and more likely, I'm not saying it's always the case, more likely to have a bear market with stocks going down a lot. So this is such an important chart, I think, just to level set expectations.
Absolutely. And a year ago, we might have shared a similar chart, and we said, hey, listen, can stocks be down 2 years in a row? Of course, they can be down 2 years in a row. You see on there, we had a 3-year bear market, stocks down 3 years in a row during the tech bubble, then 73, 74. Last I checked, those were recessions. We said there'd be no recession. So the odds of being down this year, in our opinion, if you avoid a recession, to be down 2 years in a row was very slim. It doesn't usually happen like that. And again, that's where it is. And believe me, you can have stocks pull back in a non-recessionary year. I mean, we just had a 25% bear market. We avoided a recession. We had a 34% bear market in 1987. So trust me, stocks can go back down a good deal if you can avoiding a recession. But normally the worst markets tend to take place in recessions. Fortunately, again, into next year, we do not see a recession, which is why we remain overweight equities here, looking for low double-digit returns as it pertains to stocks. So Sonu, let's talk about the macro backdrop, kind of the economy, and why we think we can avoid a recession. I guess what do we have first here? Well, we've got some indicators and the balance sheets. What do you want to talk about? Which one do you want to talk about first? One on the left or the right?
Let's start with the left, and I won't spend too much time. I could spend a long time talking about it.
Yeah.
But look, we get a ton of macroeconomic indicators. The unemployment rate, credit card data, income data, what companies are doing with respect to investments and housing, all of that, right? So it's just to get our heads around all of it. What we do is put them all together in one big indicator, right? That's what you see on the left. And right now, what does it point to? Long story short, it says the U.S. economy is continuing to grow close to trend. Yep. Right? I know we just saw 5% plus GDP growth, which is incredible, I should say, because trend growth is around 2.5%. We think that's going to continue, right? And that's the story of the chart on the left. No sign of recession. Recession would be negative growth, especially over a few quarters. And broad-based negative growth. It affects every sector of the economy as opposed to just one sector here or there, right? That's what we're talking about when we say recession. Now, the right chart gets to why we don't think there'll be a recession even going forward, right? And why, to be honest, why we didn't think there'd be a recession even coming into this year. Household finances are probably in the best shape, Ryan, that they have been ever, right? If you look at net worth this is across the entire universe of American households, right? Take assets over liabilities, net worth, right? Assets minus liabilities. And you normalize that because you have to, because disposable income keeps going up over time, right? That's running at what? 750% of disposable income. I'll repeat that. Net worth is 750% of disposable income, right? Overall for American households. That's better than what we saw before the pandemic in a pretty good economy, what we saw in 2007 and back in 99 as well, when we had a really good economy, right? Now, why is that? One is obviously, over the last 4 years, especially, stock prices have gone up. I think the S&P 500 over the last 4 years is up about 50%. That's a big
Hmm.
jump for 4 years, right? I mean,
Yeah.
yes, and that's despite last year's 2022's bear market. And then real estate prices, Ryan, have gone up. Home prices, especially for people lower down the income and wealth distribution, the biggest source of their wealth is really the home. Home prices have gone up. Now they can't really sell it and get money out, but still, it's a source of comfort. We
Hmm.
didn't have that after the financial crisis. Home prices fell, so asset values fell. And at the same time, the other side of the coin is liabilities, right? We haven't had to have American households haven't had to go deeper into debt over the last several years. So debt liabilities as a percentage of disposable income is about 100%, which is where it was in 2019 and where it was before in 99, in the late 90s, right? Before the financial crisis, actually liabilities started to go up a lot. There was a lot of
Sure.
borrowing. That's why we had a housing bubble. And then when things crashed, it got really bad. We are not in that position right now. Household balance sheets, like I said, best shape, dare I say, ever.
Yeah, and that's you argue that's somewhat controversial when people hear that because they understand there are some cracks that are out there and some issues that are out there. But again, the truth is, people that own equities, that own houses, the last several years have made a good deal in their overall net wealth there, and that's something important. Some other reasons, though, Sonu, we don't see a recession: the labor market. I mean, if we keep printing jobs and keep making jobs in this country, and companies keep hiring, it's hard to have a recession in that scenario, right?
No, exactly, right? Because if you think about why a company is hiring, that means people are, they're seeing more demand in the future. Where is that coming from? That's coming from spending. That's coming from incomes. Where do incomes come from? Comes from the labor market, right? So there's a nice feedback loop. There's a nice cycle there. One thing feeds into another, and then, there's a positive feedback loop. But over the last 3 months, we've been averaging about 200,000 jobs per month, right?
Hmm.
By the way, in 2019, what we thought was a good economy, jobs or average monthly job rate was about 163,000. To keep up with population growth, every month we need an additional 100 to 125,000 jobs. We're running close to double that right now. And then you look on the right, I know everyone likes to look at the unemployment rate. It has gone up this year. It went up between October, from 3.4 to 3.9%. But it ticked back below in November to 3.7%, right? But I like to look at the chart on the right, which is the employment population ratio, and for prime age workers, right? So it takes out the impact of people leaving the labor force. A lot of baby boomers are retiring. And at the same time, it controls for definitional issues as to who's looking for work, things like that, right? The prime age, 25 to 54, employment population ratio is actually about, in this chart, it says 80.6%. It's actually, after November's data, 80.7%. That
Hmm.
is higher than at any point, Ryan, in the last 2+ decades. We are basically in the best labor market. Forget 2019. We're probably in the best labor market since the late 90s.
Yeah, we hear a lot about people don't want to work. People don't want to work. It's simply not true. If you look at the data, if you want to work, the jobs are out there, and there are a lot of people that are working. So we've got about 10 minutes or so. So we need to keep things rolling. Sonu, inflation was the big story last year. Honestly, it's still a big story. I mean, you look at these surveys of what matters to voters. Inflation is like right near the top. But talk to me about it. It feels like inflation's coming back down, right?
Yeah, and inflation has, right? Like what we see here is actually the Federal Reserve's preferred inflation metric, which is the personal consumption expenditures index. More often than not, it's the CPI, it's Consumer Price
Hmm.
Index that's coded. They kind of run in parallel. It's the same trend, right? The absolute numbers may be different. But look, inflation's fallen from a very high level back in June, 7 to 9%. June of 2022, it's back down to 3%, right? That's because energy prices went down. But the good news is everything else is going down. Food prices are going down. Used and new vehicle inflation is coming down. Housing rents are going down. That's a big piece of what the Fed likes to look at, which is core services and core inflation, which strips out volatile food and energy prices, right? But I think what matters is, over the last 3 months, core inflation, like I said, that's what the Fed likes to look at. That's running at 2.4%. Their target is 2%. So I would say going into 2024, the inflation problem, at least for now, Ryan, I think is over.
No, that's obviously a nice thing. It's something that we're somewhat anticipating, actually, why we were so optimistic about this year. And Sonu.